Gem International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond, recently discovered in Africa by a fellow Canadian junior, with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Rick Ackerman, editor of the newsletter Rick's Picks. His website is rickackerman.com. He's speaking to us from Superior, Colorado. Welcome back to the show, Rick.
Thanks for inviting me on, Jim.
Gold has had a great run, and now today another rally. Is this still all connected to Brexit?
I don't really connect much of anything to Brexit. I mean, we've had kind of a flurry of activity that I think was pretty meaningless, as Brexit itself was. I think things will be back to normal once all the ripples subside. But when you come right down to it, I have a hard time, first of all, seeing Brexit as a bad thing. You know, if you did away with the European Union next week, it could only be a net plus for the economy, because you would cut out all those fat cat bureaucrats in Brussels. And if you abandon the Eurozone and the Euro currency with the simple statement that we are going to go back to the free trade practices that were envisioned by the common market, then who would miss the EU? So the mere fact that one country, Britain's having exited, can't be a bad thing or even significant. So gold is going up for reasons that I don't know either. It's stronger than I'd expect it to be, and I've been pretty bullish on gold, with the current target up above 1,400. Actually, the most immediate target is 1,380. That would be August COMEX, which is about $20 above the high today. So beyond that, though, I could see a move well above 1,400, and silver has had some pretty spectacular moves itself.
Is silver probably the best bet right now, with gold getting a lot of action?
Well, you get more pop with silver, because I think it's got some catching up to do, essentially, in bringing the gold-silver ratio from 80 to 1 to more like about 40 to 1. So silver is, let's say, higher beta, and the corresponding difficulty there is that trading silver contracts is it's pretty hairy, because the contract size is bigger than gold, and when you're on the wrong side of a move in silver and it goes blip, 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 you're out $1,000. So, but I see more of a play in silver if you're interested in the speculative high volatility prospects.
Silver, then, something you have to stay really on top of?
Yeah, and you know, it doesn't help to be trading the mini contract in silver. It is mini, but the problem there is that there's not much liquidity in those contracts, so you really get rate getting in and getting out, and it winds up being better probably to trade the full-size contract. But again, it's not for the faint of heart.
Someone once suggested to me, just buy an ounce of silver every month and you'll be okay.
I talked to someone yesterday, a friend of mine, who had accumulated a lot of silver on the way down at $40. And of course, it's going to be a long time before that guy sees a return on that would-be strategy of buying, you know, just continuing to buy silver. I guess if you bought steady as she goes, just 1 ounce per month, and you go back to when silver was bottoming, you're not doing too badly, but you could be on a hook there for some very pricey silver as well. So I'm going to always argue in favor of the timing model, that the one-size-fits-all, just to put away a little bit each month is going to do you. I think you do better with timing, provided you have something that generates good signals.
The price of oil down over $2 a barrel today. Is that a trend?
Yeah, I think so. Everything, the entire rally in crude from low 30s up to a recent 53 and change was, in my view, a dead cat bounce. And yeah, that's a pretty powerful dead cat bounce, but the oddity was, and the thing that had to make you skeptical about crude's rally, is that the story pushing it was always about possible shocks to the supply side. In other words, we were going to have something so horrible happen in Venezuela that their oil output would absolutely cease, and you put that together with threats, jihadi threats to supply in places where oil is a big product, and maybe throw in the slowdown in production out of Nigeria, and when you put all those supply side things together, supposedly they're supposed to make crude oil prices go up, but I don't think that's a pretty weak story. Typically bull markets in crude and higher prices are driven not by rumored perceived threats to the supply, but on the demand side, where the global economy is going great guns, and that's a good story to drive crude higher. But nobody believes that the global economy is going great guns, and further to the point, no one believes that could even be so looking out ahead a year or 2 years. So it's the demand side that is really a good bull story for oil simply isn't there.
Well, you did have a shock to the system in Canada with the Fort McMurray fire taking out 1 million barrels a day, but that lasted only about a month. And then once they allowed people back into the city, production was right back up again.
Yeah, that was good for a little pop, and that was about it. And that's about all we're getting out of all these, again, supply-side stories that are just, you wonder who gins those stories up.
Are we seeing a higher rig count out there?
I'm sorry, higher which count?
Rigs? Oil rigs?
There's been a lot of capacity has certainly been curtailed, and we're sort of in that right on the cusp there, especially for fracking, where, if you have $50 crude, it does coax a little bit more supply from the fracking industry. But it's really much harder to take rigs out of production than it is to, let's say, temporarily decommission a fracking field. So fracking is a little bit nimbler, a bit more agile, and you could expect, the gap between supply and demand to be filled in relatively easily if prices were to go higher. But what we're seeing, we've got supposedly additional supply coming online from the Gulf of Mexico, and this sort of defies the laws of supply and demand. But nonetheless, Gulf oil has been a factor in holding the lid on prices. But just looking at the global economy, it's hard to see $60 a barrel, which is where all the storytellers put that was their next goal when crude seemed to be holding at 50. But I think crude's due for range trading between 50 and 30 over the next few years.
Now, we did have some forecasts from some analysts at the start of the year that they expected $60 oil by July. Why would they have said that, and why didn't it happen?
Well, again, it didn't happen simply because there's not global energy demand to make it happen. and there's certainly ample supply. So as far as why they would say 60, well, it just comes with the story. Once we get to 50, then 60 seems doable. And of course, there's a lot of urgency in getting crude prices higher and higher. That's why the stock market, tends to rally when crude prices are up. It's mainly because the banking sector has loaned so heavily into energy-based resources, energy collateral, that they absolutely need crude oil prices to be higher in order to avert some banking crisis.
We'll have more with Rick Ackerman right after the break.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Rick Ackerman. Rick, we know that India apparently is doing not bad. Are they a major factor in the oil play?
Well, if the rest of the global economy were going great guns, they would be, because at the margin, a strong Indian economy is certainly capable of exerting pressure on crude prices. But I'm not going to say that India's growth is happening in a vacuum, but it's really not enough to surmount weakness elsewhere, particularly in China.
And China, of course, is facing the robot revolution. Apparently 1 million jobs lost at Adidas because they're not going to have humans stitching up their shoes. They'll have robots doing that in Germany.
Yeah, I guess the reality of machines has certainly come to China, and certainly nothing happens in China in a small way. China, I guess the day when China can generate strong economic growth with domestically is a long way off. And of course, that was their goal a couple of years ago when the export economy was stronger. But it looks like there's been a bit of a setback there to internal growth.
Well, they've seen other factories close as well, and jobs go to places like Vietnam. So,
Right.
So China is being out-China'd.
Right. It's amazing when you look. You think, well, here's a low-cost producer that can create a man's suit for $6.20, and you have production coming online from places like Vietnam and even Cambodia, where everything can be made even more cheaply. And we see that, when I'm amazed when I go to places that sell clothes for rock bottom prices, how rock bottom they are. If you go to Kohl's or Walmart or Costco, you see lots and lots of goods that seem, even from the consumer standpoint, these things seem underpriced. It's like, how can they make this nice velour pullover with the zipper and sell it, make a profit for $8? But they do somehow.
What's the outlook on currency right now?
I've got targets way lower for the British pound. We're sort of holding the $1.30 level, but my bear market target for the British pound is $1.06. And if that happens, we're going to be living in a different kind of world. It's hard to say really what kind of things would accompany a slide in the British pound and a corresponding increase in the dollar. The strong dollar is putting a lot of pressure on U.S. Exporters, manufacturers, multinationals, and it's certainly not a good thing for the U.S. economy, but the dollar market is so huge that unlike short-term interest rates, it's something the Fed cannot manipulate. The dollar, I'm bullish on the dollar for quite a while, and I've been forecasting at a minimum a move up into that 120 range that we saw in the early part of the millennium.
Right, and what's the outlook for the Canadian dollar? Because it's tied to the price of oil so much. Oil goes down, the Canadian dollar, no choice but to go down?
Yeah, I mean, for better or worse, your currency is resource sensitive, and the Canadians had a pretty nice rally from a low of around 68 U.S. cents to current 77. The high of the move was about 80 cents. And it looks like it could take another leg up, and of course, if it does, that means that implies there is some sort of resource-based rally, natural resources in the offing. But over the last month or two, the Canadian has struggled to go any higher. It seems like it's in a churn right now.
What's the forecast for bonds?
Well, you know that in the past, when we've talked about it, I have been absolutely in love with bonds for years, and I continue to hold to a forecast of 1.64% on the long bond. It's a bet. I love going against the whole world on this trade, and it's been a very good one. I've been more or less shouting from the rooftops about bonds being the place to be. And the one thing that's put everyone on the wrong side of this trade is the arithmetic. You think, well, if long-term bonds were 15% in 1981 and they've come down to 2.17% or whatever it is, how much lower can they go? And the answer, arithmetically, is not too much lower. You come down from 15 to 2%. They can only fall another 2% before they go negative. But the fact on the investment side, if you are long something that's 30 or 40 years out the yield curve, such as muni strips or zero coupon bonds, then you're very leveraged to small changes in interest rates currently. So if long-term rates decrease by just a little bit, you get a pretty significant move higher in the price of the bonds. And it's simply because the bonds are really discounting the slightly higher rate, the coupon, the face value, against everything else that's yielding less. So your bond that has a 2.3% yield is going to increase in value quite a bit if you extrapolate that 2.3% yield over the next 30 years. In each of those years, you're just doing better than anyone else would be doing with bonds purchased at the current rate.
You said there's an incredible amount of money tied up in negative yielding bonds right now.
Yeah, I think the figure is something like $11 trillion, and that's a lot of money. It raises the question of how much is stimulus achieving. The idea is we make rates so low that nobody wants to be a saver. They're all taking their cash out of savings and doing something with it. And of course, that something in the case of the U.S. stock market means just pushing it higher, irrespective of earnings and things that are of fundamental significance. So, but you can see that where the rubber meets the road, we're not getting much economic growth at all. We've got very little wage growth, and for the most part, manufacturers don't want to invest in more production. They simply want to buy their own shares, and that's what we've got on a grand scale. So, but $11 trillion of negative yielding papers, that's a very significant sum, and it certainly is a whole different phenomenon from what we saw in the 1930s depression, when interest on short-term treasuries in the U.S. turned negative briefly. Now it's sort of built into the global economy.
Is that a drag on the economy when people know their long-term money is going to be less worth or worth less?
Well, it'll be worth more actually because we're in a deflation. I think, and I've argued this for 20 years, that you need to have a deflationist perspective to be able to understand and explain what's going on out there. So part of it that certainly would have kept you on the right side of bonds for what has been so far a 36-year bull market. But in the main, deflation implies a very strong dollar, and it's the one thing that the central banks can't control. There's just the game is much too big, and it's not like trying to manipulate short-term rates. The dollar is huge. We've got, as a piece of it, a quadrillion-dollar derivatives market that's mostly denominated in dollars, so you don't really do much to manipulate that market. Market forces will prevail.
Rick, thank you so much for chatting with us.
Thank you for inviting me on, Jim.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.